Interesting as well, Aaron, is when you get this word out of factories around the globe right now. An interesting piece in today's Financial Times. Wall Street Journal had expanded on this not too long ago as well, revealing weakening demand. That could be very, very telling in and of itself. Weakening demand usually means a soon-to-be paired labor force. What do you see happening?
Well, yes. Unfortunately, that's also what we're looking for is weakening demand so that inflation can come down. That's actually, the goal. But certainly, people have to expect that as we're contracting from this extreme inflation, you have to complain about one or the other, right? And so with lowered inflation is going to be, lower economic activity. And so there are going to be those pain points. And certainly with the technology companies, it's a little more exposed because they did see such incredible growth over the past year.
And maybe we're still in that comeuppance period, Steve. But I'd be curious to ask you, Steve, a lot of people were buying yesterday on the notion that a 10-year note, a 10-year bond, was trading well under 3%, I believe 2.89%. So well off from the 3.5% high, a little more than a week and a half earlier. The reason why I seize on that is that maybe the Federal Reserve, and maybe this is what the markets were pouncing on, won't have to raise rates as much. But to Aaron's point, if you're doing it because things are going to slow down to the point that you don't, that's a double-edged sword, isn't it?
Yeah, look, Neil, I think we're already in a recession. The numbers just came out a couple of days ago from the Federal Reserve Bank of Atlanta that are saying that the GDP declined by 2% in the second quarter on top of 1%. Decline in the first quarter.
1.6, right? 1.6% in the first quarter, right?
Right. Look, my only point is we're in a recession right now. I think the Fed has been way behind the curve, Neil. I mean, I've been saying on this show for 9 months that they should be raising interest rates faster. And the point that I think is really important in terms of how do we avoid a crash landing is, in addition to the Fed raising interest rates, we need supply side policies. We need to be reducing taxes to end the war on American oil and gas and increase our production, reduce the regulations. And unfortunately, Neil, I'm seeing none of that out of the White House. In fact, they're pointed in the other direction. When they were in Europe, all they talked about was windmills as some kind of solution to our economic problems. So I have to say I've turned pretty pessimistic about the economy in the second half of this year. But long term, I'm still pretty bullish on the U.S. economy.
All right. Emily, let me ask you a little bit about that, because flying in the face of that is these packed airports, packed restaurants, packed Broadway shows. It doesn't quite jibe with the notion we're entering a 70s stagflation environment, not across the board at least. And I'm wondering whether there's more strength here than we give the economy credit. Now, clearly, retail sales and the growth there have slowed. Consumer sentiment surveys reveal pretty much what Steve outlined, that we're getting to be kind of bummed out about this, understandably. But is there something here we're not appreciating that shows a better foundation than is generally sort of shared?
Sure. So the services side of the economy is the one area, in addition to the labor market, that is still holding up pretty well. That's usually sort of the last shoe to drop, though. So we would expect a delay in terms of the challenges there. And if Steve's right, and if we are in a recession based on 2 consecutive quarters of negative GDP growth, we actually might be halfway there already. Over the last 100 years, the average recession has lasted 12 months. I think, though, the key from an investment perspective is to figure out what parts of the market are priced for a recession and which parts aren't. You look at the S&P 500, we're down in a bear market, down over 20%. The average bear market since World War II sees a decline of 34%. So we may already be two-thirds of the way there. You look at the bond market, though, and Neil, you mentioned bond yields earlier, not priced for a recession. In fact, usually when economic growth is cooling, investors place a bid for high-quality assets, which have very low default rates, which brings bond yields down. Right now, in this part of the cycle in 2022, bond yields have been moving up. So we would actually be looking opportunistically at this massive backup in bond yields. You're getting 4% owning high quality bonds right now. We'll take it all day long. as economic growth here is decelerating. So finding those dislocations in the market, we think, is key to cross-asset performance for the rest of this year.
No, but it's interesting what you're saying about, the 100-year period. I know Steve Moore and I covered that first recession 100 years ago, and it's amazing what's happened since. But Aaron, let me ask you a little bit about something Emily just mentioned there about these higher yields in some cases that, if I could flip it around and say it could be bad for stocks because, you invest in a security that is protected, it beats a roll of the dice in stocks that is not, right?
Right. The only thing that, to her point is that we have been seeing the stock market hit much harder. And if you look at whether it's prepared for a recession, if it's better prepared for the worst case, if it's already built into the prices, those prices that decline has been more reflected within the stock market than the bond market. So if there is a recession, actually, you're probably going to get hit less hard on the equity side versus the bond market, just because there's so much more pessimism. It's been a little more emotional. But that's also because we have a lot of conflicting information. And one of the things that is very different about this, as we probably are going to be a technical recession, 2 quarters, is that the employment is very strong. And again, it's just services are doing well. So it's not like a lot of other recessions or the 70s where you did see, high unemployment. And so we do have to take all of those components into account and be ready to turn on a dime, because this might be a very short-lived, very quick recession as we slowly try to navigate and turn the economy around, which is not so easy.
Not so easy, but